Hey guys, welcome back to Chalkboard Tutorials. So, in this episode, we'd be going through bonds, the different types of bonds that are available, and what some of the classifications of these instruments are. So, let's jump straight into it. The first thing to keep in mind is what exactly bonds are, and bonds, quite simply put, are debt investments that are issued by either governments or large corporate entities. And the reason for that is to sort of quickly raise finance or for to sort of offset excessive spending. So what the governments and the companies tend to do is go out and give out a bond, which is a debt instrument, which promises to pay you a rate of interest. It could be fixed or variable. And the second thing is they offer to pay back the principal at maturity. So those are the two things that classify a bond, which is quite simply a debt instrument. Now, these loans are usually at fixed rates, although it's not compulsory, and they can be issued for anywhere between 5 to 30 years, and you can get the odd bond that's issued for 50 years, although they are increasingly rarer, but it is possible. So now let's look at why said government or corporate entities prefer to issue bonds. Now, as mentioned earlier, the reason they issue bonds in the first place is to meet excessive spending or to quickly raise finance. So the first problem they might run into is that banks may not be able to lend for the particular term or period or even the particular amount that's asked by the borrowers. So banks may not be able to lend it, so the easier thing for them to do is to issue bonds. Now, the second thing is the bond markets tend to offer a wider range of lenders. So they have a bigger pool of investors that they can reach out to and hopefully raise higher amounts of money than is required as well. And a good example for that is London is the world's largest market for international funds. So they offer a wider range of investors that they can pull from, of lenders. And the final reason is quite simply bonds tend to be a lot cheaper or the cheapest manner of borrowing money there is compared to going to a bank and getting a loan. Bonds tend to work out in the long run as being cheaper, or the cheapest manner of borrowing. Now, similar to the US, in the UK you have companies that go for capital markets for large transactions as opposed to going to their banks. Now, let's have a look at some of the definition of bonds. The thing is, if you have a look at the bond markets, they tend to go by different names and they have different characteristics associated with different types of bonds. So it's very simple to have a basic understanding of all of them. So the first thing we're going to look at is something called a negotiable bond. So negotiable bond. And what that is very simply, once you make the original loan, so you buy the bond or the fixed income security, the first thing you're going to do is you can then sell it to the secondary markets. So the lender can then sell the entitlement of the interest and the capital repayment back into the secondary market. So that's all a negotiable bond is. Quite simply, after making the original loan by buying the bond, the lender can then sell its entitlement and interest to the secondary market. You buy it and then you put it on the secondary market. The second kind of bond that we're going to be looking at is, let me just take that away. Right. The second type of bond that we're going to be looking at is something called a fixed interest bond. So, fixed interest bond. And it's, again, pretty straightforward, just like the name suggests. What the fixed interest bond offers is the borrower is committed to paying an interest on the nominal or the face value. Now that's very important. We'll go into it in a bit more depth, but the borrower, so the bank or the corporate entity or the government, is committed to paying interest on the face value at a fixed rate for the entire duration of the loan. So if it takes 10 years, 20 years maturity, it has to pay the fixed rate for that entire period. So fixed rate. Right. Now, let's look at the third type of bond that we have available is called a long-term bond. Now, once again, as the name suggests, these bonds are usually issued for a maturity that can range from you can get long-term bonds from between 5 years to 10-year maturities, and the common one is 20 and 30-year maturities. On the odd occasion, you might get a 50-year, but again, as mentioned earlier, they are increasingly rarer. So the chances are you'd usually get one between the range of 5 to 30 years. The final kind is a debt instrument. Now, a debt instrument, pretty simple, as the name suggests, is just a financial instrument that represents debt. So, as the name suggests, it's just a debt instrument. Now, there's a few caveats that you should keep in mind. The first thing is, not all bonds pay you a fixed rate of interest. Although that is the popular form of bond there is, not all of them have to pay you a fixed rate. Some of them provide you with variable rates of interest, some of them are inflation adjusted, and some pay no interest at all.